Oh, and look at that. It is another spectacular day here in South Florida. I am Kenny Polcari, your host of the party, and today is May 25th, 2022. And what is it that you need to know? What's happening in the markets that are really going to drive the action today? So the NASDAQ continues to get slammed as investors are reducing their appetite and their risk. Eco data starting to show cracks in the foundation. New home sales reacting to higher interest rates, and we saw them collapse. FOMC minutes are due out today at 2 a.m. and we're going to try the Ratatouille for dinner tonight for the weekend barbecue because it's a great addition to everything else you're going to be serving. So the beating continues, right? Stocks under pressure for most of the day yesterday. The NASDAQ going deeper and deeper into bear territory, now down 28% year to date as concerns deepen over economic growth, rising interest rates, rising inflation, and uncertain Fed policy all continuing to weigh on the markets. Snap being held responsible for the negative tone in the NASDAQ yesterday. The Dow, which had been down about 1.6% at the height of the day, found buyers and rallied into the closing bell, rising 48 points on the day as money moved into the big industrial names. The S&P fell 34 points, or another 0.8%. The NASDAQ lost 270 points, or 2.3%. The Russell fell 30 points, or 1.6%, and the transports lost 180 points, or just over 1%. Economic data confirming what we are all expecting and what lies ahead. S&P Global Services PMI fell to 53.8, down from 56 last month and missing the estimate of 55.7, taking it closer and closer to the neutral line, which is 50. Recall, the U.S. economy is a 75% services economy, so this statistic is very relevant. And while 53.8 is still in the expansionary territory, it is inching closer and closer to contractionary territory, anything sub 50. The S&P U.S. manufacturing PMI remained steady at 57.5. The Richmond Fed survey was expected to show a 10 reading, surprised analysts coming in at -9, not a good read. And the big data point that investors were waiting for were new home sales. Now look, pressure is on the housing market as economic concerns rise, and 30-year mortgage rates are now 80% higher than they were in January. So at some point, we should see housing activity come under some pressure. The report, which was expected to be weak at down 2%, came in a stunning negative 16.6%, and last month's report was revised even lower, reflecting the weakening housing picture. Now, this should not be a surprise, right? Artificially low interest rates and COVID have been pushing housing prices higher and higher, and now conforming loans are running at the rate of 5.5%, and jumbo loans are running at greater than 6% and going higher. Many buyers are now reconsidering what to do. Now, the slowdown in new home sales says nothing about prices yet. It just speaks to slowing demand. A collapse in prices is the next event as higher carrying costs take buyers out of the market, and home builders recognize that the party just might be over. So here's what's next, and here's what you got to expect. Buyers who contracted on new homes 6 or 7 months ago, when conforming mortgage rates were at 2.75% and jumbo rates were about 3.5%, may no longer be able to afford the house now that rates have spiked higher, and they will be forced to give it up. Remember, you can only lock in a rate 90 days ahead of the closing. So while you contracted on the new house back in November of 2021, that was not expected to be completed, say, until August of 2022 and maybe later due to supply chain concerns, you're not able to lock in a rate until June of 2022 at the earliest. So a $500,000 mortgage at 2.75% in November would have cost you $2,040 a month plus taxes and insurance. It's now going to cost you $2,838 a month plus taxes and insurance, and that's assuming you get a 5.5% rate and not higher. So you either have to put more money down to have a smaller loan size, or you end up not qualifying any longer for the mortgage, and that takes you out of the market. And that is when you're going to start to see housing prices decline, right? So does any of this sound familiar to you at all? I mean, it must, right? Because look at the theme about what's happening. So this is exactly what we've been seeing in the stock market, right? As interest rates rise and the economic environment deteriorates, investors are recalculating what stocks are worth in a weakening economic and rising inflationary environment. And that new figure is very different from the old figure. Remember, I've been telling you that this is nothing other than a simple math problem. When the inputs change, then the answer must change. So while investors were willing to pay, say, 24 times forward S&P earnings in 2021, they're only willing to pay 19 times forward earnings as of yesterday. And the estimates suggest that they're only going to be willing to pay 17 times by year end. And that means that the indexes must move lower to reflect the declining valuation rate. And individual stocks in individual sectors all trade at their own valuation rates. So correction in those prices is also what you're seeing. And we have been seeing it, right? It's across the board in all the indexes. And if interest rates continue to rise faster than expected, the equation changes yet again, resulting in an even lower valuation rate, which will continue to put pressure on stocks, right? That's the issue that we're all dealing with. And lower valuations mean that buyers are no longer willing to pay elevated prices. So they're not. They move lower, leaving a void in bids, causing sellers to trip over each other as they run for exits in the building. Now, this doesn't mean that the buyers are not there. It just means that they are more price sensitive. So get ready, because that's what we're about to see in the housing market as well. Buyers will become price sensitive as interest rates and the cost of money goes up. And none of this should be a surprise to you, whether it's new homes or there's existing home sales. None of it should be a surprise to you. So as the market weakens yesterday, we saw strength in utilities, right? The XLU up 2%. It's boring, but they're big dividend payers. Consumer staples, XLP, up 1.6%. Again, boring, but big dividend payers. Energy and healthcare also rose slightly, up 0.4 and 0.3% respectively. Tech and tech-related got slammed, right? XLK down 1.5%. The semiconductor index lost 2.5%. Consumer discretionary lost 2.6%. Communications down 3.5%. Housing, the XHB gave up 2.6%. Retail lost 3.3%, and the list goes on. 10-year bond yields are once again under pressure as money moves into the safety trade, sending treasury prices higher and yields lower. Yesterday, yields ended the day at 2.75%, and this morning they're lower again. At 6 o'clock this morning, 10-year treasury yields were at 2.73%, and what that's telling you is that the bond market does not believe that the Fed can do what they say they could do, that they cannot be as aggressive as they suggest they can without sending the economy down the drain and into the abyss. The whole, we can manage a soft landing argument is no longer an option. Soft is not happening, right? The idea of a soft landing is out. Oil closed flat in the day, but it's up 1.6% this morning at $111.60. The story today is all about tight supply and rising demand now that the Memorial Day weekend is upon us. The summer driving season has officially begun, and consumer demand is expected to rise, and with that, energy prices and gasoline will rise as well. Resistance now at $112.80. If we test and pierce that, then watch oil test the March highs of $120 a barrel, and with that, you'll see gasoline prices continue to rise through the summer, and that's also going to cause angst with Americans, consumers, and investors. U.S. futures this morning are really flat, right? Dow futures are down 30 points. The S&P was down 2. The NASDAQ down 2 points. The Russell's up 2 points. So it's relatively all trading around the flatland. After the bell last night, we heard from J.W. Nordstrom's. And in a twist, investors took that stock up 9% in the after-hours trading after they surpassed sales expectations and raised their full-year outlook. The talking point here is that shoppers are refreshing their closets for long-awaited occasions. I go, yeah, okay, let's go with that. I mean, that's fine. That's what you want to believe. Let's go with that. Because they did raise their guidance, so that is a positive. Eco data today includes mortgage applications, and they have been down week over week. So what will today show? Durable goods, expectations of up 0.6%, ex-transports of up 0.5%. And at 2 p.m., we're getting the FOMC minutes from last month. What will we learn? Anything new? Hardly, unless, of course, the minutes suggest that a pause might be in order, as Atlanta's Fed President Rafi Bostic hinted on Monday. To me, a pause suggests that the Fed does not know what to do, period, right? That they're confused, and that is not a bullish decision at all. But hey, what do I know? Tomorrow brings us the revised first quarter GDP, expected to be negative 1.3%. It also brings us pending home sales, and they're also expected to be weak, down 2% month over month and down 8% year over year. Friday brings us the Fed's favorite inflation gauge, the PCE deflator, and that's expected to show an increase of 6.2% year over year, which would be slightly lower than last month. And they will use that to confirm that inflation, in fact, is in retreat if it comes in at that rate. The risk, though, that it does not. So sit tight because prices are going up everywhere. So to see it come in, honestly, would be illogical for me. But hey, look, I guess you can make numbers do anything you want. Markets have been all over the place and they are expected to remain volatile, but opportunities are being created. And while the path of least resistance appears to be lower still, there are stocks and sectors that may have already bottomed out or are closer to bottoming out than others, which is why you need a plan, which is why you just can't sit there and remain paralyzed. Patience is a virtue, and patient investors are now finding bargains in very solid, good quality names. Do not let the noise distract you, and while that's difficult, that is exactly what you need to do. You need to remain focused and do not get caught up in the emotion of it. Look, it is okay to pause for a while, right? Just don't fall asleep, because now's the time you should really be paying attention to opportunities that are being created. The S&P closed last night at 39.41 after trading at a 38.75, 39.55 trading range, right? 3800, 38.55 seems to be a level that the market is getting more comfortable with and may continue to test to see if the buyers are willing to defend that position. The action will continue to be driven by the next set of data points, today's FOMC minutes, June's Fed meeting, and the message that comes out of that. Are we on a path of consistent 50 basis point increases, or is that about to change? Are year-end Fed fund rates still at 3.25%, or are they looking to be higher? And what if they're lower? Are investors growing weary of anything that the Fed says now? Is the Fed losing credibility? And that's going to be another issue that investors are going to have to face. Look, these are all legitimate questions, right? They are going to drive the action, but they are not a reason to bail. And by the way, if you haven't bailed yet, now is not the time to bail at all, because we're closer to the bottom than we are to the top. In fact, I would argue that the market is trying to put in a bottom, right? I'm trying to be optimistic, but I do recognize that it could change all on a dime. So you need to stick to the plan, know what you own, and know why you own it. And when the opportunities are created, then maybe you put some more money into the names that you own and you like and that you know. Okay, so what are we having for dinner tonight? Well, Memorial Day weekend is coming, and so this is a great dish that you can serve alongside or with your Memorial Day dinner, and it's a ratatouille, right? Now, it's a traditional French dish of stewed veggies. Ratatouille comes from the French word touiller, meaning to toss the food, right? Because when you make this dish, what you literally do is you toss it all together. Right, now you can use this as a side dish, you can use it as a main dish, you can serve it over pasta, you can serve it over rice, and it's going to work really great with your weekend barbecues. You put it on the table with all the other food that you're presenting. So what do you need to do this, right? So it's a thick and delicious, yet it's not overpowering at all, right? And if it's done right, everyone's going to be happy, right? The left wing will be happy, the right will be happy, the Democrats, the Republicans, the center, everyone's going to enjoy this dish as they enjoy your summer barbecue. Okay, so what do we need to get this going? It's such a beautiful day here. The sun is coming out. I can hear the ocean in the background. It's gorgeous. So here's what you need. The key ingredients: garlic, onions, zucchini, both green and yellow. You need eggplant, bell peppers, green, red, and yellow. You need carrots, celery, basil, crushed tomatoes, salt and pepper, oregano, and olive oil. Right? Those are all the things you need. Then if you're going to put it over pasta, you need some rigatoni, but we'll get to that in a minute. So peel and cube the eggplant, lay it out on paper towels on the counter for about 30 minutes or so, and kind of let the water come out of it, right? You can put a little bit of salt on it, that'll help the water come out. Now slice up the onions, the peppers, chop the carrots and the celery, and cube the zucchini. Set that all aside. In a big pot now, you want to, a big stew pot, you want to heat up some olive oil. About maybe a quarter cup, a half a cup or so. You're going to add the crushed garlic, saute it for a bit. Now add the onions and saute those until they're translucent. Now add the peppers and the carrots and the celery and continue to cook on medium heat, right? Until they feel about soft. Should be about 15 or 20 minutes or so, right? Now finally add the cubed zucchini and the eggplant. Mix it well, season it all with salt and pepper. Cook for another 10 minutes or so. Taste it. Now add a can of crushed kitchen-ready tomatoes, not puree. You want the crushed kitchen-ready tomatoes, right? And depending on how much you're making is going to depend. You need 1 can or 2 cans. You have to decide that. Now add the fresh basil, a bit of oregano, and cover it. Allow it to simmer for about an hour. Turn the heat down to simmer, cover it, and let it simmer for about an hour, but stir it occasionally, right? You want to taste it. Feel free to adjust the seasoning as you taste it, right? But it's going to have this really wonderful smell and taste if you've done it right. At this point, the ratatouille is complete. Now you can decide to serve this over pasta, and if you do, you got to serve it over rigatoni, because rigatoni is a nice big pasta that accommodates this dish really well. But if you do that over pasta, make sure you always have to have plenty of fresh grated Parmigiana cheese on the table for your guests. If you're going to just serve it as a side dish, just put it in a big bowl and serve it, warm to room temperature, along with your burgers and your hot dogs and your baby back short ribs, whatever you want. But either way, it's a great dish to have for barbecue. It's a great dish to have for a lot of people, and it's just a great dish to know how to make because it's so good. In any event, look at this day behind me. The sun is coming out. There's a couple of clouds in the sky. The sky is blue beyond that. The palm trees are green, swaying in the wind, and I'm here in South Florida. And until tomorrow, take good care.